step by step. Okay, I think we'll go ahead and call the meeting to order. Get the microphone up here. Okay, so our first order of business is to consider the minutes of the July 20th, 2022 meeting. Does anyone have any changes? If not, is there a motion to approve?
There's one thing on this particular copy, and I know you sent out a new one, but just so it's in the, oh yeah, never mind. Forget it. I make a motion to approve. I can't read.
Is there a second?
Second.
Okay, all those in favor?
Aye.
Any opposed? Okay. All right, next we have Natalka from Chartwell Consulting on the phone to review our third and fourth quarter 2022 and July through December 2022 plan performance and flash reports and various other reports, as well as the rebalancing recommendation for our pension plan. Hi, Natalka.
Good morning, everyone, and Happy New Year. I think it's maybe a little bit beyond the time that I can sort of say that, but since it's the first time I'm speaking with most of you. The way, Aaron mentioned, there's a lot of material that we could cover since the last meeting was back in July. I might suggest that we start with the fourth quarter and the 2022 performance. We do not have the full reports done, but we were able to update all the performance summary tables. So we have the performance both for the plan and the individual managers. And we also have the December and year-end flash report and rebalancing recommendations. So I think if we start with that, it will, I'll be able to make some comments that will pull in some of what went on during the rest of the year. But I'm happy to address any questions you have on any of the materials that Aaron mentioned. I'm just trying to keep it, sort of a relevant meeting within a decent amount of time. So how does that sound?
Good.
That sounds great.
Okay. Well, as I normally do, I'm just going to start off with a few brief market comments on the fourth quarter and the full year of 2022. I think it'll help you put the performance of your total fund return as well as individual manager performance in better perspective and knowing the environment that everyone was operating in. Well, as 2022 drew to a close, there was a global market rally in October and November, which unfortunately reversed a bit in December. So we finished the year with a negative month of performance. However, October and November were strong enough that the fourth quarter was the first positive quarter for both stocks and bonds in 2022. I'll start off with some comments about U.S. equity markets. So 2022 was a negative year. Large cap stocks fell about 18%. It was the worst year of performance for the domestic stock market since 2008, and it was the seventh worst year of performance for the U.S. stock market since 1926. In the fourth quarter and for the year, from a market capitalization standpoint, mid-cap stocks fell the least. For the year, they dropped 17%, followed by large cap stocks, which I just mentioned, were down 18% for the year, and small caps lagged at minus 20% for the year. From a style standpoint, for the month, for the fourth quarter, and for the full year of 2022, value dropped less than growth. Or said another way, value outperformed growth quite strongly. For reference, for the year, the differential between large cap value stocks and large cap growth stocks was a little over 24%. So large value stocks for the year dropped about 7%, and large growth stocks dropped about 30%, 29 to 30%. That's a historically wide differential between those two styles. In the fourth quarter, there was only one negative performing sector. That was consumer discretionary, led down by Amazon, weak results from Amazon and Tesla. All other sectors finished in positive territory. The three best performing sectors, both for the quarter and the year, were energy, materials, and industrials. Moving on to international markets, starting with developed markets, it may come as a surprise to hear that both for the month, the quarter, and for the full year, developed international markets dropped less than U.S. markets. With everything that's going on globally, from Russia's war in Ukraine, from China's zeroed COVID policy, which really shut down their economy for most of the year, to its reversal in late December of lifting COVID restrictions, I don't know that many people would have anticipated that international stocks would drop less than U.S. stocks, but that indeed was the case. And it was the case in emerging markets for the month and for the quarter. They dropped less and made more in the fourth quarter than domestic stocks. They did not for the year. They were down in the same area as U.S. small cap stocks, down 20%. If we move on to the bond market also posted its first quarter of positive performance in the fourth quarter. The 10-year Treasury yield actually rose slightly from the end of September, where it was at 3.76%, to the end of the year, closing the year at 3.88%. This, however, masked a lot of intra-quarter volatility, where the 10-year in October actually touched 4.25%. So from October through year-end, interest rates fell, enabling fixed income markets to finish the quarter in positive territory. Once again, for perspective, this year, the 10-year bond started the year at 1.51%. And it finished the year at 3.88%. That is what accounted for the significantly negative year of performance. The Fed also raised rates about 4%, which impacted the 2-year and under, the short-term rates, which rose even more than long-term rates, resulting in the fact that we had an inverted yield curve for most of the year. For the quarter, as I had noted, the Barclays Aggregate Index did finish in a positive territory, up 1.9%, and the Intermediate Aggregate Index was up 1.7%. However, for the year, the Aggregate Index was down 13%, and the intermediate aggregate was down 9.5%. The only two positive performing segments of the bond market for the year were floating rate bank loans, up 0.7%, and 90-day T-bills, which were up 1.5%. So a very negative, a red ink year for both stocks and bonds, unfortunately. Real assets posted mixed results for the year. The bright spot and one of the only positive performing segments of the market for the year were commodities and natural resources, up 18.5% in the fourth quarter and up 34% for the year. Global and U.S. REITs, real estate investment trusts, those are equities associated with real estate holding companies, fell in line with broader equities in 2022. Global REITs were down minus 23.6%, which was a little bit less than U.S. REITs, which fell a bit further, down 26% for the year. So that is the market backdrop that your managers were operating in. You might have in front of you a set of tables. I don't know if for the performance of the total plan and the individual managers. I don't know if they're projected on a screen. So if you don't mind following along, the group of tables is called fourth quarter 22 trailing performance versus benchmarks and universes. So that's what I'll be working from. The total plan finished the fourth quarter slightly ahead of benchmark, up 7.4% versus a target policy of 6.2%. For the year, it was a negative year for the plan, down 14.4%, which was a little bit lower, about 0.5% lower than the blended target index of 13.9%. From an asset standpoint, the plan finished the year with $155.6 million, which was up from September 30th, where the plan was at $145 million. It was down in assets for the year. The plan started the year with $180 million in assets. When we look at the 4 investment teams that comprise the plan's total fund return, 2 of the teams posted good relative returns. Absolute returns were all negative for the year, but on a relative basis, the domestic equity team dropped 15.1% for the year. Their blended target index, so blending together large, mid, and small cap indices, which you have represented on your domestic equity team, that blended index dropped 21.4%. So your domestic equity team outpaced their target index by about 5.5%. So, the other good relative performance, again, maybe somewhat surprisingly, came from your international equity team. And the international equity team dropped 17% versus 18.5% decline for their blended target index. The weaker performance in your plan was driven by primarily the global fixed income team. They dropped 11.7% for the year, whereas the blended target index for the fixed income team dropped only 10.4%. And we'll go over specifically where the weaknesses were in a moment. The real asset team also posted weaker results, down 15.1% for the year versus down 11.9% for the blended target index. Within real assets, your plan has a natural resource fund and also 3 REIT funds, 1 global REIT fund and 2 U.S. REIT funds. And within that composite, it was the REIT exposure that was damaging in 2022. I'm going to go to the second page of the performance tables, which is the fixed income team performance. And as I said, this is where this was one of the weaker teams, but you had some fixed income managers that performed better than others. The strongest performing manager that you had is one of the largest, or is actually the largest of the fixed income managers, which is Pinnacle Fixed Income. They run an intermediate, primarily credit, but also a little bit in mortgages and government bonds. For the year, the Barclays Intermediate Aggregate Index was down 9.5. Pinnacle was down only 9.5. Pinnacle was down 5.8%. So again, defensive performance and good relative performance. Lord Abbett is your high-yield manager. High-yield bonds did not escape the market's wrath. In 2022, the index was down 11.2%, and Lord Abbett dropped a bit further, down 13.4%. They're a pretty aggressive high-yield bond manager. They tend to invest in some of the lower quality portions of the high-yield marketplace. That did not work to their benefit in 2022. Western Asset Income is a multi-sector bond fund, so it invests in high-yield bank loans, CLOs, asset-backed securities, and also investment-grade securities. You've been invested with them since April. They dropped since that time 7.6%. So they outperformed what a strictly high-yield bond manager would have done during that time period. And the weak link, to me, in your fixed income team is TCW, Total Return. They are predominantly a mortgage manager. Probably between 90 and 95% of their holdings are agency, non-agency, commercial-backed mortgages, and other asset-backed securities, and then some treasuries. They do not invest in corporate bonds within this portfolio. It makes them a good complement to Pinnacle Financial, which is mostly corporate bonds. So between those two, you have solid, if you will, core U.S. bond exposure. TCW was down 16.6%, underperforming the mortgage index, which was down 11.8% for the year. And the reasons for their underperformance was they had a longer duration. They also were overweight agency mortgage-backed bonds, which underperformed non-agency, commercial mortgage-backed, and other asset-backed securities. So they had in many ways, an unusually weak year of performance. What I will say is, coming out of the chute in the first 18 days of January, fixed income has started the year off pretty strong. Most fixed income strategies are up between 2.5% and 3.5%, and TCW, Lord Abbett, Western are all above 3% starting off the year. So, they're positioned pretty well for the marketplace as it stands currently, but they did have a difficult year last year, as did many other active fixed income managers, as well as bond index funds. There was really no place to hide in fixed income markets. One of the things this year that I think that you'll be seeing in future monthly flash reports and rebalancing recommendations from Chartwell is that we might begin, we have begun sort of rotating the portfolio a little bit more towards higher quality. So trimming some of Lord Abbett and the Western Income Fund and sending that money to Pinnacle and or in the future to TCW, Total Return, if their performance continues to improve, and sort of, if you will, increase the credit quality in the portfolio. In years past, I think that sort of the greatest risk in the portfolio, and certainly last year, was duration risk. You know, we were in a low interest rate environment. We knew that at some point in time interest rates were going to go up, so we were positioning the fixed income portfolio in shorter duration and also in higher yielding sectors of the bond market, whether that was investment grade credit or other sectors within the bond market that were higher yielding. I think as we look at 2023 and going forward, duration risk comes off the table a little bit because I don't know that interest rates are going to go up much higher in 2023. They'll probably stay at current levels and or retreat a little bit by year end. So it's a good time to sort of improve credit quality and not shy away from duration as much as we have been in the last couple of years. So some of my recommendations going forward will emphasize those points as opportunities present themselves. So, and just as an example of that, I had noted that the 10-year bond ended the year at 3.88%. Well, here we are 18 days later, and the 10-year bond is down to 3.48% this morning. So I think that interest rate volatility will continue in the short term, but I think that we've seen the peaks of interest rates, particularly in the long end of the market. If there aren't any questions, I don't mean to just run on. If you have any questions at any point, please jump in. But if not, I'm going to move on to domestic equity, which was one of your best relative performing teams, both in the fourth quarter and on a year-to-date basis in 2022. Pinnacle is your largest U.S. equity manager. They run a large cap core with a slight growth biased portfolio. For the year, they matched the drop of the index at down 18.1%. Brandywine Dynamic Large Cap Value, as the name implies, is your large cap value manager. Large cap value dropped far less in 2022 than large growth. The index was down 7.5% for the year. Brandywine dropped slightly less than that at minus 6.4%. You have two mid-cap managers, Harbor Mid-Cap Value. The index was down 12%. They were down 5.6% for the year. Janus Enterprise is your mid-cap growth manager. The mid-cap growth index was one of the weakest performing segments of the bond market, down 26.7% for the year. Janus defended well and dropped 16%. Vanguard Small Growth also a weak performing sector for the year, down 26.4%. Unfortunately, Vanguard small cap growth dropped a little bit further, down 27.9%. Your small cap value manager is American Century, and they matched the decline of the small cap value index, falling 14.5%. All in all, I don't see issues with your domestic equity team. There's none of your managers are on watch list. You have exposure to both growth and value, and also exposure across all capitalization ranges. I would say that the portfolio probably has a slight value bias because Pinnacle is not a deep growth manager. They're really a core manager with a growth bias to it. And your other in your other categories, the mid-cap value and small-cap value managers, have a very strong value bias, as well as Brandywine, very strong value bias. So that, I think, on a relative basis, helped the domestic equity team significantly in 2022. The international equity team, you have 2 global managers, 1 international manager, and 1 dedicated emerging markets manager. I noted in my introductory comments and my market recap that international outpaced U.S. markets, or fell less than U.S. markets for the month, quarter, and year. So I'm going to start off just with talking about your 1 dedicated international manager, Dodge & Cox. They had a very defensive year of performance. They dropped 6.8% for the year versus down 16% for their target index. They do have a value bias. They are a core manager, but they have a value bias, and that was beneficial because the value style held up much better internationally as well as domestically. Your 2 global equity managers, meaning they invest generally between 35 and 45% in the U.S. markets, and then also in international markets. One of your managers is American Funds Capital World Growth and Income. So this manager invests in the U.S., invests in developed international markets, and also in emerging markets. For the year, they were down 17% versus their all-country world index down 18.4%. Janus Global Research has more of a growth bias. They are a growth manager. They do not invest in emerging markets. They invest primarily in U.S. and international developed markets. They were down 19.5% for the year, underperforming their index, which was down -18 slightly. And again, it was because of their growth bias. Invesco Developing Markets is your dedicated emerging markets manager. They had started off the year with a very rough first quarter of performance. They did have exposure to Russia. And so when Russia was expelled from the index at the end of February, beginning of March, they had to mark those positions down to 0. They're still held in the portfolio, but held at 0. They also had pretty significant investments in China, which also had a very weak start to the year. They came on much stronger in the 3rd and 4th quarter. They were not able to close the gap fully, but China began to recover for them. But they finished the year down 24.9% versus down 20 for the index. All of these managers, I should have mentioned it as well with the domestic equity managers, have started off 2023 in a very strong fashion on behalf of the plan. All of them are ahead of target, and the strongest performing manager, equity manager, strongest performing manager in the first 18 days of 2023 is the Invesco Developing Markets Fund. I think they're up about 8%. So, let me just check that quickly. Up 7%, 7.1. And then I'll finish off my performance comments with the real assets managers. You have 3 REIT managers: Prudential Global REIT, Cohen & Steers Realty Class, which is a U.S. REIT fund, and Principal Real Estate Securities, a second U.S. REIT fund. REITs were down as a little bit more than broad U.S. equities. The global REIT fund dropped 26.7% year to date, and the 2 U.S. REIT funds were each down 25% on a year-to-date basis. The U.S. REIT funds fell in line with their target index. The Prudential Global REIT Fund fell a little bit more than its index. The bright spot for the markets and for your portfolio in the for the 2022 was the Commodity Natural Resource Fund, up 17.4% in the quarter and up 32.8% for the year. So, as I mentioned at the onset, it was a negative year of absolute performance in all but commodities and natural resources. But on a relative basis, the vast majority of managers in your plan held up very well within their categories, and you unfortunately did have one bond manager and then the REIT managers, which both the asset class and the managers took, a pretty strong beating versus traditional equities, that caused the total plan to slightly underperform on a year-to-date basis. Any questions on performance of the plan or any of the managers before I finish off with the monthly flash report and rebalancing?
I don't see any questions.
Okay. Hopefully that doesn't mean everybody is stunned and in shock. So the December flash report you should have in front of you as well. I had noted earlier that the plan from an asset value standpoint finished the year at $155,590,000. So $155.6 million. From an asset allocation standpoint, the plan remained overweight in equities. The target is 42%, and you're currently at 47.7%. And the equities in that total equity target and also your actual allocation are the traditional equities, your large cap, small cap, mid cap, and also your global and foreign equities. It does not include the real assets equities. The real assets equity target is 23%. You're slightly underweight that target at 21.9%, and that's primarily due to the slightly weaker performance of your REIT managers. And on the fixed income side, your fixed income is underweight 28.7% versus a 34% target. And again, a part of that is the weakness of the fixed income markets during 2022. Your liquidity, or what I sometimes refer to as operational cash in the portfolio, there's a 1% target. For the last 18 months or so, we have been running double that, closer to 2% allocation. I think it's just prudent for during periods of high market volatility for the plan to have operational cash that would cover about six plus months of your plan expenses, meaning benefit payments and other plan expenses. And now certainly that money markets are certainly earning a yield once again. It was, last year when you're holding that cash, you were earning 0. Now you're earning, between 1.5% and 2%. On those funds, so which looks really good compared to fixed income at some points. So we continue to recommend that you keep closer to 2% and overweight that operational target, because we do think volatility is going to continue in 2023, but hopefully we'll also see some more upside volatility versus downside. I think that will definitely happen in the fixed income marketplace, and hopefully if the Fed feels that they have inflation under control and begins to slow down the rate of interest hikes and potentially pause their interest rate cycle, hike-breaking cycle, that perhaps we will either have a soft landing and a shallow recession, or I don't know if it's possible to avoid a recession totally, but I think that fixed income will hold up well. Equities may face a little bit of a challenge, but I think that equities will have a better year in 2023 than they did in 2022. There were no rebalancing recommendations for the month of December. I would say since July, the rebalancing activities that have occurred in your portfolio have been to trim some overweight equities on strength when there were rallies, like we had a rally in July and August, and we trimmed some equities and sent money to cash. We also trimmed a little bit of fixed income on strength as well as equities in November after that October and November rally to rebuild cash, and also to send some money from lower quality fixed income up into higher quality fixed income. So that's the type of rebalancing activity that has occurred in the last 4 or 5 months. We're not recommending anything, as I said, this month and in coming months, other than to, keep the asset allocation within your minimum and maximum ranges. I just, potentially see a rotation from lower quality fixed income to higher quality fixed income appearing in some of my recommendations. I think from a style standpoint within equity, you have a good blend of value and growth, and I would maintain that blend. I think that value stocks will continue to perform well in 2023, but I also think that growth stocks maybe have found a bottom, and should begin a recovery. I don't know if the recovery will be a real snapback. So I think, again, maintaining a good distribution between growth and value is a positive.
Okay. Does anybody have any questions or comments for Natasha?
Fun year.
Well, Natasha, I know that you have been on top of this, and it's been an exciting time for you and your group. Hopefully, it continues to be exciting, but in a positive way this year.
Yes.
I like what you've seen the first 18 days of the year. Hopefully, that trend keeps up. Did you have any other information to share with us?
No, I think that, not recommending any sort of manager changes at this point, not any allocation changes, so I think we're good.
Okay, well, thank you again. We appreciate all of your information, and your monthly commentaries that we get in email are very helpful as well, so thank you very much.
Okay. Definitely my pleasure.
Okay, so the next item on our agenda is to hear from Sterling Price and Katie Gray of USI to present the annual review of our pension plan. Hello.
Hi, good morning. So, wasn't sure how to do this, but I think everybody should have a copy of these slides, and next time, if it's preferable, we can put it on the screen, but I'm just going to talk through this. First of all, let me introduce myself, Sterling Price, and joining me is Katie Gray, Michael Guyton, who served the city for probably 20-plus years, retired at the end of 2021, so this is our first time to be in front of you. But, I worked with Michael for pretty much the entire time he was there, sat next to him for most of that time, so I feel like I've kind of through osmosis have heard of the discussions about Murfreesboro, and he had questions. We would discuss things. So excited to be here. Unfortunately, my first time is coming up, right in the midst of the asset volatility you just talked about. So Michael's going away present was he got to enjoy the strong 2021 asset returns and didn't have to present here. One other item of housekeeping is, so if you see on the front, at the bottom logo, USI Consulting Group. Our firm, as Michael probably discussed, at the end of 2020 was acquired by USI, and now we are rolled into a brand called USI Consulting Group. So we're still in the same places. Our email addresses are all the same. It's just more of a branding move going forward. So. Okay, so what I'm going to do is just kind of talk through these. Feel free to interrupt me. I know actuarial information can kind of get into the, thank you, can get into the weeds a little bit. So feel free to stop me if anything's not clear. But I'm on slide first, on the first page 1, and we'll talk through the agenda. Just, we do evaluation. This is as of July 1st of 2022. We'll go through the assumptions, kind of how the calculations are done, what assumptions we make to perform those. You kind of got a little summary of the assets. We'll talk a little bit about the asset picture we take as of the valuation date. And then we'll go through the different types of evaluations we're doing. One is to calculate the funding requirements for the upcoming fiscal year, and then the other is your GASB results, is what your accounting results show on your accounting books for the end of the fiscal year. So slide 2, pardon me, is just, the valuation is simply, what it is just a snapshot. We're taking a picture of the assets and the liability of the plan as of June 30, in this case 2022. The plan, as you know, is a long-term obligation. It's supposed to run over the course. Evaluation is just simply hitting the pause button on that movie to see what the liabilities and assets look like. And what it's based on is simply, the plan provisions. What does the plan provide? The participants, a census of who is still in the plan. It compares it to the plan assets as of that date. And then the assumptions and methods we use are to take each participant's projected benefits and how we calculate those, and then how we discount those back to determine a present value of the liabilities. So slide 3, the funding method is just a way to develop a contribution methodology to put into the plan each year. I mean, obviously, a way to do it, an unadvised way to have a pension plan would just be, as people retire, you just pay them out, make contributions to pay out the benefits at the time. What we're trying to do is just develop a long-term approach to put money into the plan over time, so that at the end of the day, there's enough money to fully fund everybody's benefits. So that's simply what the entry-age normal funding method is, just a actuarial term, a way to determine the benefits, the liability of the benefits that have been accrued to date. Our method is to, and that was developed in 2001, is to take the unfunded liability, or the difference between the assets and the liabilities, and we amortize that over a 40-year period back in 2001. And we'll get into a little more detail on that as we go forward. Simply, but on slide 4, simply the ultimate cost of the plan, though, is just the benefits that are paid to participants, less the money that's been put into the plan, and then less the investment income that the investments earn on those employee contributions. Okay, so let me, on slide 5, goes through the assumptions. Investment return, we are assuming a 7% long-term rate of return. And let me emphasize the long-term rate is the emphasis there. Obviously, we know that there's no investment manager who can develop a pool of investments to specifically every year guarantee a 7% rate of return. So what we've determined is that the current mix of investments over a long-term period of time, 7% is a reasonable expectation, recognizing that each year we're going to ping pong on either side of that line. So obviously we're coming off a year where we were in the negative. I think we were about negative 14% for the 12 months ending in June. Again, that's coming off of we were over 20% for the 12 months ending June 21. So just want to emphasize even though we don't hit, we're unlikely to ever hit that number exactly, the emphasis that it's a reasonable long-term assumption. And again, we look at these assumptions every 5 years to sort of see how we're doing, especially the investment returns and these other demographic assumptions, to make sure we're still in the ballpark of what's reasonable. We're due to look at do an assumption experience study to compare our assumptions with what's happening. We'll do that probably at the end of 2023. So that's the end of that was last done in 2018. So a 5-year cycle, which would put that due this year. So we're assuming a 4% annual salary increase for those participants who are still active and earning benefits in the plan. The base mortality table is a Society of Actuaries table that was published in 2014. Usually the Society will publish updated tables every 10 years, so we're still, that's still a reasonable expectation. And you may have a question of what does, obviously COVID had a pretty significant mortality, or at least short-term mortality impact on this country. It'll be interesting to see what those studies show. I mean, I think, the thought is a lot of those the people who died from COVID were sick anyway, so that's one thought, but I know that they're looking at that, so we'll probably have some more information on that as we get closer to when the new table is published. But we do assume that a year-over-year mortality improvement scale, and what that simply means is that an age 65-year-old person this year compared to age 65-year-old person next year, the mortality next year is slightly lower, and that's what's meant by that mortality improvement scale, and we do update that each year and apply that to the base table. Withdrawal and retirement rates are pretty self-explanatory. The withdrawal simply means the participants who terminate employment but not yet at a retirement age. Retirement rates would be those that are at age 55 or later, and under our assumptions would start receiving benefits at that date. And then for plan expenses, you have pretty level expenses in terms of your total assets. So we just set that expense rate equal to the prior year number. Well, that's simply what we do. So withdrawal rates, again, that applies to usually the younger people, and we use a service band for that. We found that it's more, when people leave, is more tied to how long they've been with a company as opposed to how old they are when they're not yet at retirement age. So you see, you don't have any people who are less than 10 years of service, so then the rates different. Well, withdrawal rates are the same for the general and the fire and police. But on the next slide, you see the difference for the retirement rates for the general and fire and police. And fire and police get a more subsidized early retirement benefit, so that's why we assume more of them leave at an earlier age. And then obviously all of them out in the fire and police by 65. And obviously there's some people who are still working at those rates, and what that would just mean is that the next year we would assume that they, each year that they're above that age, we're assuming that they leave in the upcoming year. So that's what that means. Okay, so assets, let me highlight this a little bit. This is what we're using for, this is an actuarial tool which allows us to kind of mitigate the volatility in the markets. Is we're using what's called a 5-year smoothing method, which simply means that we are only recognizing 20% of each year's gain or loss in the calculation of the asset total. So it's more of an average over a 5-year period as opposed to just taking the market value and saying that's what we're using. So over time that may give us a number that's, if we're coming off of a strong year, an average number which is below the market value, and if we're coming off of a poor performing year, our actuarial asset number may be higher than the market value. But again, those gains and losses are recognized over 5 years, and what that is intended to do is to not only mitigate and to level off the asset total, but when we go through the calculations, is to give you a more level contribution rate for the amount to. So you're avoiding extreme spikes not only in the asset total but in the recommended contribution rate. It allows you to budget for a more appropriately and more predictably. Okay, so slide 9 gives a graph of the assets and kind of puts in pictures the words we just talked about. So you see that, and those lines are fairly close, but the darker blue line is the market value, and you see how that's ping-ponging on either side of the somewhat smoother lighter blue line, which is the actuarial value. So we are, while our actuarial value was below it in 21, we are now above it, the market value in 2022. Again, that's been pretty consistent as we've seen, or at least the last 15 years or so. A poor year of performance is usually followed by a better than expected year, and hopefully that's something over the next 2 quarters of 2023 we can hopefully experience. But the tool is that if we have another poor year this year, the averaging will be layering in those positive years from 2021 and 2019. So that'll help us. Asset return, similarly, like what we talked about, you see how the gains and the lighter blue actuarial value of assets are not quite as extreme as the sharper drops and increases in the market value line. So we were, I believe, at negative 13%, 14% for the 12 months ending this year, while we were above 25% for the 12 months ending in 21. While we only recognize, so that those positive returns allowed us to, the actuarial asset increase by not quite at the 7% we were expecting, but at the 5% line. So, okay. Okay, so slide 11 gives a historical kind of snapshot of this, who's in this plan. A reminder, the plan is closed to new entrants, so we would expect this number of, and that number, top line is number of active employees. So 455 active employees, down from 491, 21 versus 22. Covered payroll for that group is just over 34 million for an average of just shy of 75,000. Average age, 51 and a half, and all, as you can see, all those numbers for most of that group goes up, about a year as a total. Then retired participants, those would be the group that is drawing monthly benefits from the plan. And then deferred vested is simply a term for participants that have earned a right to a future benefit in the plan but are not currently working. So they have either not yet reached retirement age or have reached it but have elected not to start their benefit yet. So for a total of right at 1,100 total participants in the plan. Okay, so present value of benefits is an actuarial term which simply means is what it says. It's the present value today of all the future benefits that we expect to pay from the plan. So the way to think of that is if the plan had, and for this calculation we'll just assume it's a little bit over $225 million. If the plan had exactly $225 million and all of our assumptions were exactly met, we exactly earned 7%. All the current employees earned, exactly that 4% salary scale. They all died exactly when we thought they would. The plan would be writing its last check to the last participant with the last dollars in the plan. So you wouldn't have to put any more money into it. It would just simply, it would exist on its own, and it would die at the same time that the last participant died. Now, obviously, we don't have quite that much money. Our assumptions aren't going to be, we're not going to hit exactly all of our assumptions exactly each year. But that's just an idea to tell you kind of the difference. The difference between the assets and the present value of benefits is what you need to, over time, fund the plan, earn earnings on those investments, and then that's what we measure each year to see how we're doing in that comparison. So the three different bars, the darker bottom bar is the assets in the plan, the medium blue line is the unfunded liability. What that means is the difference between the assets and the value of the benefits that have been accrued to date. And then the top gray bar is the value of the benefits we expect to be earned in the future. So you see you have a pretty mature group. We talked about the average age of the actives was over 51 years old. So we don't anticipate too much, and the plan is closed, so we don't anticipate too much additional growth of the liability in terms of additional service from active employees earning additional service, additional salary increases, and that's what I mean by a mature plan. So over time, that gray bar is going to get smaller and smaller, although the total bar is going to increase as the accrued benefits. For that active group, their benefit in the gray is going to move into that middle bar. And so then once everyone is terminated, we'll just have the assets and the value of the accrued liability will be the same as the present value of benefits. Okay, so slide 13 gives a comparison of where we are historically as a funded ratio, comparing the accrued liability, the darker blue bar, to the assets. So you see, although the assets increase, the total overall the liabilities increased by more than the assets. So our funded percentage dropped from, I think we were just over 85% to just shy of 82%. And that's represented by that gray line to a chart on the right. Okay, unfunded accrued liability, I talked a little bit about that, is just simply the difference between the present value of the benefits that have been earned to date, shown there at $207 million, compared to our actuarial asset value of just shy of $170 million for an unfunded accrued liability of $37.5. We're amortizing that, was initially set up as a 40-year period, currently 19 years remaining on that, so that adds $3.4 million to your recommended contribution rate. And what that's intended to do is just to, over a period of time, eat into that unfunded liability. Okay, which gets us to slide 15, which talks about, and well, this will kind of go into a little more detail on the contribution rate for the next, or for the upcoming fiscal year, 23-24. So we talked about on the last slide, the 3.4 million. Normal cost is an actuarial term which represents for those active employees, the present value of the benefit expected to increase in the upcoming year. So just a one-year cost of 2.76 million. Plan expenses, again, set to last year at 367,000. We assume for just this purpose that the calculations made in the middle of the year for so the first three lines would be calculated as of the beginning of the year. We assume there's an increased cost of that due to interest for the 224,000, which gets us to a total of 6.7 million, or 19.8% of the contribution rate, based on a projected payroll of 34.1 million.
Our current rate, I believe, is right around 18.7, 18.8% that we're contributing right now.
18.73.
18.73.
Does that mean come budget time, you'll be allocating more?
That's right. We'll incorporate that as part of our budget automatically.
But the payroll amount, that's relevant too, because you have fewer people
True.
than the year before
Right.
that are active, because some have retired.
Yep.
So the percentage is a little bit misleading when the payroll.
Right. I think that's something we'll probably, as that, like you said, you make a great point, that as the number of activists are starting to get smaller, even though you may have a much higher percentage of payroll, even though the total dollar amount is much less. So that's something we can talk about as we get into, I don't know with the number of activists we have now that it still applies, but it doesn't necessarily drive it as much as once we get much smaller.
It just gets, as that percentage gets larger, it looks scary.
Right.
But it's based on a different payroll
Right.
amount too.
Yeah, and that's something Michael.
Funding done monthly through the city's budget, then there's an amount allocated, and it's then total for the year?
It's paid in monthly
That's
based
what
on.
I'm saying. If
Yeah.
you looked at the city's income, revenue and expenses, it would show up every month
Yes.
as an expense. Okay.
It's automatically expensed with each payroll.
Gotcha.
And, yeah, just like Melissa said, and Sterling indicated, Michael has talked about that with us for the last couple of years also, before he retired, about eventually we would need to look at a flat rate contribution versus that percentage, because when you get down to the last few employees, you're going to have, 1,000% of their payroll or some ridiculous number that doesn't, it's not for that one employee, it's for the entire group.
Right. So we're looking at that, and I think it's on our radar, but I don't think we're quite there yet.
Yeah.
I think you would see something where, if you had an increase in the percentage, but a decrease in the dollar amount, that would be something that would not really make sense. We're still seeing we have an increase in the percentage and an increase in the dollar amount, so
Right.
I think that makes sense. But I think once we get to something inconsistent like that, that's when we would start maybe looking at a different methodology. Or a different reporting. The calculations would still be the same. It's just a question of how you want to,
Present it.
how you want to accept what we're presenting in terms of what you do for the budget.
For people who don't see it all the time, they zero in on the percentage.
Right.
And it's like, wow, we've got to do something, but really, nothing's changed. It's just the
Right.
the
And it's
base.
also tricky that this is just a subset of your total, since not everybody's in the plan, and your salary number is much different than what we're projecting as just the salary amount for this small group. So, I get what you're saying. I think that's a good point. Okay, so on slide 16, that gets to sort of where we were, kind of you see over the last few years, we've been right around between 18 and 19%, or just shy of 20 this year. You see that the big increase in 2018, that was driven by when we decreased the discount rate from 7.25 to 7%. So a simple actuarial maxim is as the interest rates go down, the liabilities and costs go up. So that's what drove the one-time spike from 2017 to 2018. But you see the normal cost, which is the darker blue line, is that's been pretty consistent over time, and that's we would expect that to maybe not year over year, but over a period of time to decrease, because that's simply tied to the number of active employees. Okay, so slide 17, this kind of in numbers tells the story of what's on the graph before, but you see on the far right column, that's the numbers we just went over to get to the 6.7 million and the different components of that, and you can see how those have changed over time. Okay, so this maybe on slide 18 talks a little bit about in specifics of what drove the increase in the recommended rate or the actuarial determined contribution amount. So like we said, we're at 19.79 for this year, increase of just over 2% from the prior year. Salary increases were a big component of that. Increased it by 2.11. The actuarial asset return, remember, different than the market value at 5.48, increased the rate by 1.1%. And then other demographic, I guess that would be gains for this period, decreased it slightly by 16 basis points. So that's what was driving it to get to the new number of 19.79. Okay, so that kind of summarizes the funding calculation portion of this. I wanted just to talk a little bit, and we'll get into the GASB accounting, and then we'll wrap up if anybody has some questions. But just a kind of a quick tutorial on risks that all pension plans, and specifically yours, faces. One is interest rate risk, and we've seen how the difference in the rate we use to discount future payments directly ties to the changes in present value. So, interest rate risk sort of ties to market return. So if we're assuming a 7%, that's intended to mirror the expected long-term rate of return of the plan. If we don't over time hit that 7% bogey, that's going to increase the long-term costs of the plan. So we talked a little bit about the contribution risk, and that second bullet kind of talks a little bit about how, the expected contribution rate is expected to increase over time, even though the number of, the true dollar amount may decrease, just tied to the number of active participants. Longevity risk is just simply that, people are living longer, and your plan is set up to pay monthly annuities for people's or their beneficiaries' lifetime. So to the tune that those participants live longer than we expect, that's an additional cost to the plan. So we're trying to capture that through using updated mortality tables. Obviously, plan of this size, people are different. There's people who are in better health than others. So we're able to we're taking an average. Obviously, there are going to be some group of people that do better and some that do worse. Our hope is that we kind of have an equal number on either side.
Question there.
Yep.
You're using tables for that, right?
Yes.
I'm reading in the Wall Street Journal, COVID, opioid, et cetera, has actually decreased our life expectancy in this country. Are those tables up to date, or are those new tables out, or
Yes,
would that
the tables do not reflect COVID yet. The opioid thing would be in part reflected, and the table was published in 2014. And like I said, those are usually updated about every 10 years. And you make a good point that long-term life expectancy, again, you're looking at includes a lot of younger people. You don't have very many younger people in your plan. Most of the participants are older, and so their mortality year over year is actually improving for the older ages. We don't know the impact of COVID on that, although I would anticipate that COVID will be viewed as more of a one-time impact and not necessarily a long, something that we're having to deal with every year. I think that kind of will go into the calculations as kind of a one-year shock or multi-year shock, but not necessarily something that will have as big of an impact each year over the next 10 years. But again, that's just my prediction. We'll have some, the demographic experts will probably have more to weigh on that, and I'll relay that to this group once we have it. Okay, so slide 20, we're going to talk a little bit about the GASB 60A and what's different from that. Again, that's the numbers that go on your kind of report as your accounting liabilities as of the end of the year. So we issue a report pretty early in the fiscal year that gives the accounting liabilities as of June 30, 2022. But as you'll see, we're reporting all that information since you have an interest in reporting those as quickly as possible in the fiscal year. We take advantage of the accounting rules and use numbers that are at the time 12 months old. So these are numbers as of June 30, 21, liabilities as of June 30, 21, and report those as of June 30, 22. So these numbers are going to look better because they're Michael's numbers. He gets they're based off the number from last year, off the good asset returns. So this gives a little bit rosier picture than we really will have at this meeting next year when we're doing accounting numbers based off the numbers we just talked about. So terminology, again, actuaries love to come up with complicated words for fairly simple ideas. Planned fiduciary net position is simply the market value of assets. You see at the time, we were at almost $178 million. Total pension liability, again, is the value of the accrued benefits to date. So not including any future benefits, but just the benefits earned as of the date. Again, we reported this, it gets a little confusing. We reported this as of June 30, 22. This $190.8 million is really the liability as of June 30, 21. And then the net pension liability is just the difference between the two. So you see our unfunded liability for accounting purposes was $12.9 million. And again, for accounting purposes, we don't have the tool to use a smoothing method. So we just pull the asset value as of that date, and that's what we're stuck with, for better or worse. Okay, so the next slide kind of gives you an idea of the impact of the discount rate on the liabilities. So in all of these situations, the asset number is the same. We take a look at, in the middle column is what we're currently looking at. So you see the unfunded liability of $12.9 million. If we had used a discount rate from 7 to 6%, you see the significant increase in the unfunded liability. It would go up to $37.2 million. Similarly, if we increase the discount rate from 7 to 8%, so lower liabilities, we would actually have a surplus of about $7.7 million. So it just shows you that ultimately the discount rate and what we're using to discount all those future payments and the compounding effective interest over time, for all these payments that we're projecting 30, 40 years into the future, 1% change in interest rates can have a very significant difference. Okay, I'm not going to go into too much detail on slide 23, but that just kind of gives you the roll forward of the pension liability, the liabilities year over year from 184 to 190, the assets from 140 all the way up to 177, and then walks through the steps to get from so you see at the last year our unfunded liability was at $43 million, and it went down all the way to 12. So very strong year for the 20 to 21 fiscal year. Pension expense is made up of is an approximation of the cost of the plan for the upcoming year. Is made up of different things. Service costs is the accounting term for normal costs. That's the benefits that are expected to accrue in the upcoming 12 months. Interest is the component of the the cost of the total liability, that interest rate applied to the total liability. It's offset by projected investment earnings, and then we amortize gains and losses over a period of time, kind of roll into that calculation too. And then we add a cost for the administrative expenses paid from the plan. So slide 25 gives a history of that. That gives a history of the schedule of contributions. So last year you made, I guess for the fiscal year ending 21, you made $5.8 million versus a recommended contribution of 5.8. Okay, so like I said, Katie and I, Katie helps me manage this relationship. She's involved day to day. She's, her fingerprints are all over every page of this report. So our contact information is here. I'm really excited to work. I know Michael enjoyed working with this group, and I wish I had better news for my first opportunity to meet with you, but we're setting the bar low, so we'll be ready next year. So happy to take any questions. Hopefully that didn't get too time consuming, and that's appropriate. But I'm happy to, like I said, take any questions or any concerns that anybody might have.
On slide 5, we have the actuarial assumptions, and it shows everything updated in 2018. Is there a recommended time frame that those should be
We're going to recommend that so we would study that for the upcoming valuation. So for the 7/1/23, we would, and we'll work with the staff to get what we would need for that and apply whatever costs and be sure that everybody's okay with that. But that would be our intent, would be to, at this meeting next year, to relay any assumption, to present the results of that study and show any recommended contribution or recommended assumption changes at that time.
Okay.
So 5 years is a standard. There's not a has to be done type thing. I think we're still, if for some reason we wanted to delay it. I will say we haven't really seen anything that looks out of the ordinary. I'd be surprised, we may make some tweaks, but it wouldn't be anything that would be very radical.
Not a really significant, okay. Are there any other questions?
Melissa, when did we discontinue our pension?
It's July 1st, 2010 was when it
2010.
closed.
10, I was trying to remember. Okay.
That's why he said we didn't have anybody in that 10-year window, below 10-year service, because they all are in the other plan now.
Every employee hired since that time is not a participant in this plan.
Right.
Okay, so 12 years.
Yeah. Are there any other questions? Well, thank you very
Okay,
much.
well, thank
We
you.
appreciate you coming and sharing good and grim news, but we appreciate your time. Is there any other business on the committee? We do have a couple of information only statements in your packet there. So one is our State of Tennessee compliance letter. That's something we get every year, and we are in compliance. And then our information sheet as of December 31. And I believe that was at the very end of our packet. If there's any questions on that, I'm happy to field those. Okay. Well, I appreciate everybody's time, and I hope you have a great January. Thank you.